Hi, I'm Mark Hebner, President of Index Fund Advisors, and welcome to the quarterly market review for the first quarter of 2019. Let's look at the broad asset classes around the world to see how they did in this quarter. We had quite a reversal from the fourth quarter of 18, which we'll show you in a minute. But U.S. stocks were up about 14% for the quarter. International stocks about 10.5%. Emerging markets around 10%. And global real estate slightly beating out U.S. stocks coming in at 14.07, while bonds for the U.S. came in around 3% and global bonds about the same at 2.96. If we look at the timeline of events during the quarter, we can see that we started off after last year's loss, which was the worst yearly loss since we saw in 2008 during that global financial crisis. By the end of January, though, we had the best January in over 30 years. So go figure. Random walk of market returns right there, as clear as a bell. About mid-quarter, we found out that the fourth quarter of 2018 ended up with a 2.6% growth in the economy. And by the end of the quarter, we had Theresa May's Brexit deal rejected for the third time. And then we also heard that the Feds were going to basically not change interest rates and likely to keep them the same throughout 2019. When we look at the breakdown of global markets, geographically anyway, we see that the U.S. came in at 55% for the end of this quarter, while the international developed markets came in at 34%, and emerging markets came in around 11%. And you see that the total market capitalization, basically of all the stocks that we have in our global equity portfolio, came in at $51.8 trillion. We refer to that as capitalism incorporated, with a total market value of almost $52 trillion. Now, every quarter we like to show you the previous quarter's asset class returns, compare them to this quarter's asset class returns as a reminder of the random walk of quarterly market returns. And this one you can see clear as a bell. We went from basically all negative equity returns to all positive equity returns. And so if we were to put these in order of the 2018 fourth quarter return, we see that the short-term government bonds came out with the highest return at 1.5%. So this is why you have bonds in your portfolio, by the way, to dampen the volatility of these equities. And then we see that IFA small cap index, so these are U.S. small caps, had the worst return coming in at a minus 20%, and that's in the fourth quarter of 2018. Well, now when we go back and look at the next quarter of the first quarter of 2019, we see that the loser became a winner at 12.42%. Now, before you start thinking that that's some kind of investment strategy to buy the loser and always get a winner, you can see that that's not always the case. Some of the ones, they're basically a mix, and those bonds came in at a relatively consistent return from one quarter to the next. So that's a good lesson that you shouldn't engage in what's often called tactical asset allocation, where you're trying to look at one quarter and then forecast what's going to happen in the next quarter. It also is a reminder of the independence of each month returns. You can think of them as independent, identically distributed random variables. Look that one up on Wikipedia. So if we look at it a better way, you think about the whole portfolio, you can see here basically that the more risk you have in your portfolio, like a portfolio 100, the more volatility you end up with. So this is a really clear picture of volatility from a minus 15.83% to a plus 11%. And then we can see nice, neat patterns if we look at them based on their asset allocation of stocks and bonds. Now, we don't want you making any decisions based on any of this short-term data. Instead, we want you to look at large samples of market returns. It's why we do our back testing of the IFA indexes, so that you can get large sample sizes from which to make your decisions. And we're now up to 91 years and 3 months when we go all the way back to January 1st of 1928. And so we can then see how these various levels of risk grew in a hypothetical $1 started back on January 1st of 1928. And in that red high-risk portfolio, we now see that that $1 would have grown to $13,604. Of course, that's not adjusted for inflation, but you can see the relativeness of these various asset classes or allocations. Where if you put in 25% bonds, you see that return drops in terms of the growth of $1 to $4,673. At a 50-50 mix of stocks and bonds, the $1 grows to $1,126. And if you just bought a 1-month treasury bill over that whole period, $1 grew to $20. So that's a good justification for owning equities in your portfolio. It's a good way to basically beat inflation over that period. And of course, you want to take the risk capacity survey to find out among these various allocations which one would be the most appropriate for you. So that wraps up the quarterly market review for the first quarter of 2019, and look forward to seeing you again on the second quarter of 2019. Thanks.